Hi, everyone, and welcome to another episode of Investing Strategies. On today's show, the CFO of Roku is here to shed light on the connected TV company's growth plans and what exactly sets Roku apart in an increasingly competitive streaming landscape. Plus, the semiconductor sector is in focus as the ripple effect of chip shortages is hitting many end markets. An industry expert weighs in on how this whole thing could play out and who the biggest winners are. And meme stocks like AMC and GameStop are back in the spotlight with more rip-roaring moves. Tuttle Capital Management shares one way investors can get a piece of these hot stocks in the form of an ETF. Investing Strategies starts right now. Like many growth stocks this year, Roku is taking a break, but the streaming video platform had a huge run in 2020, surging roughly 150%. The TV advertising landscape is continuing to evolve and content remains king. So how is Roku positioned for the future? Well, Roku CFO Steve Louden is here with all the details. Thanks so much for joining me today, Steve.
Yeah, thanks for having me.
So the pandemic certainly fueled an increase in TV watching, and Roku reported 18.3 billion hours of streaming in the most recent quarter, up nearly 50%. Some huge numbers there. So with so much time spent on the platform, what's the strategy for growth of monetization on a per user basis?
Yeah, and it's been a lot of strong growth. We've been growing robustly for a long time, even before the pandemic hit, but certainly the pandemic has accelerated a lot of the trends that were underway in the shift to streaming. You know, in terms of the monetization side, I mean, that is the third phase of our business model. So really, you know, we've been working on growing scale of the platform, then driving engagement. You mentioned the streaming hours growing roughly 50%. And then the average revenue per user has been growing up very nicely as well. In fact, we just hit a record of ARPU on a trailing 12 months basis in the last quarter. Really, that's driven by a couple different categories. One is the move of advertising over to streaming from traditional linear TV, and our advertising business has been benefiting from those advertisers following the viewership. And the fact that you can have targeted, measurable advertising on Roku that you haven't been able to have traditionally on TV, as well as the fact that on the content distribution side, we've seen a lot of great growth there. There's a lot of new services for consumers. A lot of the legacy media companies are really leaning into streaming. And you know, this is all predicated on our belief that all TV will be streamed, and you're seeing more and more evidence of that. And that's great for us, both in terms of building scale and driving increased monetization over time.
We certainly are seeing that indeed. Now let's dig a little deeper into the advertising business that's hugely critical to the company's success. So what exactly is driving the trends that you're seeing in the advertising space? And maybe you can give us an example of how that's coming to life in the business.
Yeah, sure. So certainly on streaming that, you know, like I said, we believe that all TV will be streamed. The corollary to that, in our view, is that all TV advertising will be streamed. And so really the advertisers are following the viewers over, and they're frankly a bit behind in terms of the amount of advertising budget that is being spent versus the amount of time of TV watching that is being streamed. But for the most part, we're getting more and more budget. And really Roku's been leading that in terms of OTT advertising with things like our OneView platform, where you can, you know, really leverage the first party consumer relationship we have with a large streaming audience. You can have targeted advertising, which drives higher ROI. And then one of the things that's very important to the Roku offering and is differentiated is the Roku channel. So that is built on a foundation of free ad-supported television, and our reach is getting bigger and bigger. We reach households with, you know, an estimated 70 million people in that. The Roku channel on the platform is growing roughly twice as fast as the platform itself. And that's really one of the core areas of free ad-supported TV out there.
So on that line of thought with the Roku channel, I mean, we're always hearing about how content is king. Netflix and Amazon, Apple, among others, are just spending rapidly on their original content. So talk to us about what Roku is doing on the original content or programming front. You know, we have Quibi and some other things that you guys are doing.
Yeah, so certainly we've had a lot of good, exciting announcements this year in terms of the content side of the business. And really, it is framed within the context of the Roku channel and the free ad-supported TV model. But the Roku channel has grown to such scale, and it's growing very fast. It doubled year over year. And so that allows us, within that free ad-supported model that we've had, since we started the Roku channel about 3.5 years ago, to spend more on content, and we have more flexibility. So we've done things like, we purchased the content distribution rights for Quibi, and those are the core of our Roku originals that we just launched. In fact, we had our National Streaming Day holiday here a couple of weeks ago, and so that was the launch day of Roku Originals. So that's very exciting. Only found on the Roku channel. We also acquired This Old House, so that has the top couple shows in the home improvement category, and so that's something that you can find elsewhere, but also on the Roku channel. So for us, it's really exciting because this extra scale allows us more flexibility to source types of content and contents in different ways than what we were able to when we were smaller. But really, the content licensing will still be the backbone of the Roku channel, like we've done, but we have new ways of doing that. And then we have some other exciting announcements around that too, of the newly acquired Roku brand studio. And so we just basically just launching today the Roku Recommends show, where each week we'll have kind of the top 5 shows that, based on our content recommendation algorithms, we're kind of highlighting some gems of content that people may not have seen, but that'll be on the Roku channel and other places in our UI. So I'm pretty excited about that as well.
So lots going on there. And then you also mentioned the distribution side of the business. It seems like a lot of negotiations that need to happen with that side. And right now, Roku doesn't have YouTube TV on the platform, but walk us through how the distribution side of Roku's business works with all the different legacy platforms that you're saying have new apps coming on as well.
Yeah, certainly. I mean, we have a very wide breadth of content, and our aspiration is to have all content that's relevant for consumers. And so we have thousands and thousands of apps. So yes, we're always kind of negotiating or renewing the apps, and the vast majority of those are you never hear about. But for the most part, we've been very successful at having a great breadth of content, and then also using our first party consumer relationship, recommending the right content to folks in things like the Roku channel. So certainly, our revenue model is based on the fact that we can help these content publishers create a lot of value, and then we have an economic interest that's aligned with them in terms of subscription or transactional video rev shares or ad inventory. And so, we're really, kind of focused on the consumer experience, and then hopefully driving, positive results for our our content publishers, and then, gaining revenue in the meantime.
Now, Roku is, of course, a dominant player in this space, but you're not without some stiff competition. So what do you think are Roku's competitive advantages here in this evolving streaming TV landscape?
Yeah, absolutely. Yeah, certainly we've been competing successfully with a lot of big names for years. And really what set us apart is, frankly, the kind of leading belief and innovative belief years ago that all TV was going to be streamed. And then Anthony, our founder, and the early team, built a purpose-built operating system that to this day has significant advantages, primarily around being low cost, designing to run on cheaper hardware, which is really important in the TV space, and to keep prices low on the player space. And then the fact that we've designed the UI and the platform itself to just be accessible to all types of folks that aren't necessarily consumer or tech savvy. So we get a lot of both consumer and professional reviewer awards as a result that we have such great content, but it's so easy to use, and the entry point is so cheap. So these are a lot of things that have been fundamental for us. The fact increasingly that we're experts in free ad-supported TV is really important. I think that's an area where a lot of the industry kind of didn't pay enough attention to that years ago. And that's increasingly important, especially as streaming moves more international as well.
And looking ahead to the future, what areas do you think provide the biggest opportunity for Roku to deliver that strong growth moving forward? Are you looking more to be acquisitive? What exactly is going to drive the growth in the future?
Yeah, I think there's, first and foremost, a massive opportunity remaining in streaming. I mean, we are still very early days in what we've branded the streaming decade. And so we think that the US is definitely ahead of the rest of the world in terms of the shift to streaming. But when you think about the monetization, even in the US, it's still very early days. And so there's a lot of opportunity in the US remaining. But then increasingly, the streaming shift is an international phenomenon. We think all TV will be streamed globally, and so international, even though it's maybe a bit behind the US, is going to be increasingly important. And we're very heartened to see that the same differentiators that made us successful in the US market port nicely to international markets that we're in, and we look forward to kind of further expansion in international markets over time.
Well, Roku sure has seen some impressive growth, so best of luck to you moving forward, and thanks so much for your time today, Steve.
Yeah, appreciate you having me on. Thank you.
And up next, we're taking a closer look at the semiconductor sector and the long-term impacts of the current chip shortage. That's after the break.
MarketSmith will give you a huge edge in the stock market. Better stocks, bigger profits.
MarketSmith is the top research platform for IBD.
It's just the best tool for individual stock selection.
Everything within MarketSmith is designed to bring those best stocks to the surface.
It does a lot of the work for you of filtering down to the potential leaders.
It's when you take the training wheels off and you're ready to invest on a more professional level.
MarketSmith will help you take control of your investment life.
If you want to get serious about investing, start your membership today.
Chip shortage. That's one of the hottest topics of discussion on Wall Street right now, with far-reaching implications and no easy fix. Here now with insights about the issue at hand and how it's expected to play out is Robert Maire. He's president of consulting firm Semiconductor Advisors. Thanks so much for being here today, Robert.
Glad to be here.
So explain to us from your perspective, what exactly is happening in the semiconductor sector right now that's put the group squarely in focus in the investor community?
Well, I think what we've seen is more demand side or supply chain issue than it is a manufacturing issue right now. It's somewhat akin to the toilet paper shortage that we saw in COVID, not to make light of it at all, but auto manufacturers and other manufacturers stopped ordering semiconductor chips for a number of months and then turned back on several months later and tried to get back in line, so to speak, to get into the factories to have chips manufactured. And it's not quite that simple. Semiconductor factories run typically at 90 to 95% utilization. So when you lose 3 months of utilization, it may take a very long time to sort of get back in line because basically all the production slots are accounted for. It's not like making fenders or motors or wheels where you can run the factory a little bit later into the night. These factories run 24 hours a day, 7 days a week. And in addition, a lot of the factories that make chips for, as an example, the automotive industry happen to be older factories because you don't make 25-cent chips used to control anti-lock brakes in a $10 billion factory. You build those in an old depreciated factory. So a lot of those factories, you can't even expand capacity because the equipment simply isn't made anymore or there isn't adequate capacity. So what we really saw was a dislocation on the demand side and lack of management of the supply chain. It's not like the semiconductor industry lost capacity or had factories burned down, much like the toilet paper industry. Didn't see that happen there either, but there was an excessive amount of demand coming out of COVID, and there was really a mismatch between demand and ability to fulfill that demand in a reasonable period of time.
Mm-hmm. And you mentioned the automotive group. We're hearing a lot from them about how this demand issue is causing huge production constraints on their end. Do you think that that's the biggest end market that has the implications here, or where do you think that the issue lies?
Well, I think that's the end market which has the highest leverage, whereas the average cost of a semiconductor that goes into an automobile application is typically about 40 or 50 cents. But that one part can stop a whole $50,000 car from being shipped. Obviously, if it's a chip that's going into the anti-lock brake system or the transmission or the engine. And today's cars have literally hundreds of chips in them the chip value in a car exceeds the steel value in a car. Not many people understand that. And as we move into electric vehicles that have a lot more complex electronics in them, the semiconductor content goes even higher. So that's perhaps the example that has the highest leverage. But even small, cheap products such as electronic vape cigarettes have a chip inside them, and there are manufacturers of those small, few dollar items that have been unable to manufacture e-cigarettes, as an example, for lack of semiconductor chips.
So far-reaching impacts here. Now, when it comes to the semiconductor itself, who do you think are the biggest winners and losers in this situation? From a stock performance perspective, it's the chip equipment makers that have been the real outperformers as of late.
Yeah, well, certainly the biggest benefactor in all this is TSMC. They're the largest foundry in the world. They're located in Taiwan. TSM controls over 50% of the foundry market. That is the market that makes chips for other people. So they make chips for NVIDIA, for Qualcomm, even Intel. They make all the chips for Apple products. So they are really the backbone of the industry, and they are perhaps the biggest beneficiary. There are other companies who are in the foundry business. They go from small companies that make older chip technology, such as a small Israeli-based company called Tower Semiconductor. There's a company in Shanghai, SMIC, UMC, another Taiwanese company, Global Foundries in upstate New York. So there's a whole variety of companies that provide semiconductor chips across the spectrum, from bleeding edge to trailing edge technology.
And we're also hearing a lot about domestic chip manufacturing and how there are national security reasons for bringing chip production home. What's your sense of where we are with seeing that become a reality in a meaningful way?
Well, I've been talking about this for many years. Chip production has shifted from the US to overseas, and specifically to Taiwan, which is, only an hour or so's boat ride from mainland China, who has promised to reunite it at any and all costs necessary. So clearly that's a risk. If Taiwan were to stop producing semiconductors today, we'd see a problem much, much worse than the minor shortage that we're seeing right now. And even with a minor shortage, we're seeing significant impact in the auto industry and many other industries. If we had something happen to Taiwan, that would bring many, many industries to a grinding halt. So there's a huge amount of risk. In addition, from a defense and military and intelligence gathering, as you can imagine, the world has gotten more electronic with satellites and GPS and facial recognition and other intelligence and data gathering by governmental actors. And those things are more and more controlled by semiconductors and processors and artificial intelligence, machine learning, which all require advanced semiconductor devices. And China has been growing and spending quite a bit of money. They have allocated somewhere between $100 and $150 billion to become self-reliant in semiconductors. And that would have a direct impact on defense and national security if that were to occur.
So you can't build these facilities overnight, though, in the US. So there's no easy fix here. How do you see the issues in this sector playing out over the next 12 to 18 months or so?
Well, I think in terms of the near-term shortage that we're experiencing, that will likely work itself out perhaps in 9 months to a year's time. Basically, we had a dearth of ordering for maybe 3 or 4 months, and given the excess capacity that's in the system, it'll probably take 9 to 12 months to get that back in line. But as you point out accurately, it takes quite a long time to build a semiconductor factory. The two $10 billion factories that Intel is proposing to build in Arizona will likely take a year to design, a year to build the buildings, and then a year or two to order the equipment, install the equipment. So those factories that they're talking about likely will not produce chips for 4 or 5 years. So the long-term fix will take a very long time. We've lost our edge in semiconductors over perhaps a 20-year or more period. So fixing it is not going to take a year. It's going to take, really more like 5 to 10 years likely.
And do you see this demand issue now turning into a potential oversupply issue at some point?
Well, I've warned investors about that on multiple occasions. This industry has historically been very cyclical, and the cyclicality of the industry is based on a relatively fragile balance between supply and demand. So typically, if you think of a standard bell-shaped cycle, in the bottom of the curve, demand for chips is low, therefore pricing is low, therefore capital spending to build new factories is low. So as demand for chips picks up, capital pricing picks up after that, and everybody says, hey, we're making a lot of money, let's build a new factory. Everybody's shovels go in the ground at the same time. 2 or 3 years down the road, additional capacity comes online, you get into an oversupply condition, and then it takes another 2 to 3 years for the excess capacity to be sort of worn off. It's much like the real estate market, let's say in Manhattan, where there's a shortage, everybody will start building new buildings. New buildings will come online in a couple of years' time, there'll be an oversupply, prices will collapse, and we'll see the cycle repeat. So it's very much a similar repetitive organic cycle that we see in the semiconductor industry. And this current dislocation could set us up for a significant down cycle potentially.
So there's a lot for investors to digest there. How do you think they should approach investments in this sector with everything that you've laid out?
Well, I think certainly the semiconductor equipment companies, as you point out, they're sort of the arms merchants to the industry, so they really don't care who wins the wars and who gets the market share. I think they've certainly benefited, as you pointed out, and I've been covering those companies for quite a while. And there's likely also an organic demand, a secular demand for semiconductor devices, which will help soften whatever down cycle we do see. So I think that the down cycle that we have ahead of us will not likely be as bad as prior down cycles, simply because demand has become so widespread, from IoT to servers to cryptocurrency to all these things that require semiconductor devices more so than it was 10 years ago, that will help soften any sort of downturn. So certainly companies like TSM that make the semiconductors, they're in a great position. Companies like Applied Materials, Lam Research, KLA, and most specifically ASML, who has sort of a monopoly on advanced technology.
All right, Robert. Well, thanks so much for weighing in. There's a lot to unpack there, and we really appreciate your insights today.
Okay, happy to be here again. Thanks.
And coming up after the break, we're taking a look at one way to play high-flying meme stocks like AMC and GameStop, but perhaps with a bit less volatility. We'll be right back.
IBD Digital gives you access to our premium content.
The best of Investors Business Daily.
A team with decades of experience serving up actionable investing content, a sophisticated tool set to facilitate your own deep dives, and educational resources that will give you an edge in the stock market. We have over 100 years of stock market data, all focused on one thing: what makes a winning stock.
We're taking the guesswork out of investing. Subscribe now to build a better portfolio and make more money in the stock market.
Meme stocks like AMC and GameStop are once again getting a lot of attention. And though they can skyrocket in the short term, their volatility is a concern for investors looking for steady outperformance. But for those who want to ride the wave of what's trending, there's an ETF for that. The recently launched Fomo ETF. Joining me now to discuss is Matthew Tuttle. He is CEO and CIO of Tuttle Capital Management. Thanks so much for joining me today, Matthew.
Thank you for having me.
So first of all, FOMO is definitely a catchy phrase out there right now, the fear of missing out. And I think many investors experience that. Sound investing is based on rules, but emotion is also a very big part of investing. So give us your take on how investors can actually use this FOMO to their advantage.
Yeah, so there's so much going on right now in markets, more than we've ever seen. So you've got the meme stocks, you've got the crypto, you've got the value stocks. So what FOMO is designed to do is allow investors to get access to all of those areas. And then going forward, whatever happens to be the hot area, because it's going to change, over time, but to do it in a smarter way. So, we're going to have the GameStops, we're going to have the AMCs, we're going to have some of the Bitcoin things and the blockchain things. But we're going to weight those according to downside volatility. So, we're never going to have a situation where we're in a whole bunch of stuff in large amounts that gets you crushed.
Yeah, I think that might be a concern for some investors with these meme stocks is just how wild that they are. But it seems like in ETF form, you can dilute that a little bit here. But you think that still having these stocks in an ETF is worth doing?
Oh, without a doubt, because we can also balance them out against different things. So if you've got a portfolio that's got GameStop and AMC, which ours does, but then you've also got value stocks in there. You've got other types of stocks in there. That's going to really smooth out your returns, and we're going to be able to put in, the right amounts, based on risk versus return of the GameStops and the AMCs.
So you're looking at the hot areas of the market, and if you're really agile, how are you able to spot that shift as it's happening into these various areas?
So, and that's where the agility comes in. We rebalance the portfolio on a weekly basis. So we've got computer algorithms that run every week that are looking for the stocks that are in the strongest uptrend. But what we're also doing is we're looking at stocks that maybe previously have been doing well, but have sold off recently. Because the way that the markets work, typically what happens is at some point, whatever's hot, the money flows out of that, they take the profits and they go back into, whatever is sold off recently. So that's another thing that we do. And again, that happens every Monday. So it allows us to really stay in harmony with what's going on in the market.
And sometimes I think investors, when they think fear of missing out, it's investments that have already made big moves. So how do you make sure that the FOMO ETF is really staying ahead of the curve and not trying to catch up after these stocks have already made big moves and might be likely to pull back?
So a couple of things. First off, by having that counter trend piece, so we're buying stocks that maybe made big moves in the past, but have recently sold off. So we're buying them when they're low instead of buying them when they're high. The other thing we do is the trend following part of the portfolio. We're not just looking at price, we're looking at price and volatility. So a stock that maybe went up 50%, but did it with a lot of volatility might not even make the portfolio. Then the third thing we're doing is when we're looking at the strongest trending stocks, we're taking out the most recent few days. So what we don't want is a stock just popped 50% yesterday, and now we're buying it today. So that 50% pop yesterday, we wouldn't even consider. It would come right out of the algorithm.
So being very tactical with that. Investors also interested in another hot area outside the meme stocks, and that is SPACs. So how do you think investors should be looking at the SPAC market? There's a lot of buzz, but there could be a lot of volatility there too.
Without a doubt. The first thing they've got to understand is there's a difference between a pre-merger SPAC and a company that came public out of a SPAC merger. Totally different things. The volatility you're really going to see in companies that came out of SPAC mergers. And, those are the companies, your QuantumScapes, your Lordstown Motors, your DraftKings, your Nikola. Those are the companies that are going to be really volatile. Some interesting opportunities now in some of those companies. We have an index called the D-SPAC index. 25 of the largest companies that have come out of D-SPAC mergers. A good chance that a lot of those companies are going to end up being put into Russell indexes this month when the Russell rebalances. So that creates a real interesting opportunity because investors are going to be forced to buy a lot of these companies that they don't own right now.
So taking a step back and looking at this from a portfolio management angle, investors no doubt want to capture these hot areas of the market in their portfolio. How do you think ETFs like FOMO and D-SPAC fit into an overall portfolio?
So FOMO fits into a portfolio depending on an investor's tolerance for risk, but it really ought to be 10 to 40% of any portfolio. And I say 40% because it's not going to be as volatile as a lot of the other thematic things out there. We have a pre-merger SPAC ETF, SPCX, which should also be in every investor's portfolio. It's an uncorrelated asset class to the market. The de-SPAC ETFs, those are going to be rocket fuel. Those are going to be ETFs that can do, the de-SPAC index, it's going to move. It's going to move a lot. We've got a long ETF on it. We've got a short ETF on it. I can't tell you what direction it's going to move, but I can tell you it's going to move. And so we've got two different ways to play that. And that's more for traders who are looking at the de-SPAC area and deciding, hey, do I want to be long these names or do I want to be short?
Well, definitely things to keep in mind as investors dig a little deeper into these ETFs. Matthew, thanks so much for your time today. I really appreciate it.
Thank you for having me.
And thank you all for watching this episode of Investing Strategies. For Investors Business Daily, I'm Alyssa Corum.
Hi there. Thanks so much for watching Investing Strategies on our YouTube channel. If you want more executive interviews and analysis of key trends to watch, make sure you hit the subscribe button so you can stay up to date.